Hey there, savvy investors. Welcome back to the channel. Today, we're diving deep into the world of ETF investing. We're going to uncover some common pitfalls and show you how to avoid them, so you can supercharge your returns and take your portfolio to the next level. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. Let's kick things off with a little excitement. Did you know that some of the best ETFs on the planet have been absolutely crushing it? We're talking about returns that could make your head spin. QQQ has a 10-year average return of 17.38%. VGT is even better at 19.6%. And good old VTI is holding strong at 11.15%. Now, imagine having these heavy hitters in your portfolio. On average, you'd be looking at around a 15% return. That's no joke. If you were to invest just $500 a month with a return like that, in 25 years, you'd be sitting on a cool $1.3 million. Talk about making bank. But here's the thing, to make returns like that, you need to be smart about your ETF investing. And that means avoiding some major pitfalls. So, let's dive into 3 huge mistakes investors make all the time, and how to fix them. Mistake number 1, focusing solely on total return. It's tempting to look at those juicy returns I just mentioned and think, I'll take one of each, please. But hold your horses, because this approach could be a huge mistake. Let's break it down. 1. QQQ. This powerhouse is heavily weighted in technology. We're talking over 57% tech stocks. The top holdings? Tech giants like Apple, Microsoft, Amazon, and Nvidia. 2. VGT. If you thought QQQ was tech-heavy, VGT takes it to a whole new level. We're talking 100% information technology. And get this, 40% of the fund is just Apple and Microsoft. 3. VTI. This is your total stock market ETF, giving you broad exposure to the entire US market. Now, here's where things get tricky. If you're buying both QQQ and VGT, you're essentially doubling down on the same tech stocks. There's a massive overlap. 33% of QQQ's holdings are also in VGT, and about 50% of the weight is shared between the two. And it doesn't stop there. Even if you're pairing QQQ with a broad market fund like VTI, you're still getting a lot of overlap. In fact, 93% of QQQ's 100 holdings are already in VTI. Now, don't get me wrong, overlap isn't necessarily bad. The key is understanding what you're actually invested in and making informed decisions based on that knowledge. Here's how to avoid this mistake. 1. Research your ETFs thoroughly. Know what's in them, not just their returns. 2. Use tools to check for overlap between your ETFs. 3. Be intentional about your exposure. If you want more tech, that's fine, just make sure it's a conscious decision. 4. Consider your individual stock picks in relation to your ETF holdings. If you're already heavy on Apple through your ETFs, maybe think twice before adding more individual Apple stock. Mistake number 2, over-obsessing about diversification. Now, let's talk about diversification. You've probably heard that diversification is key to reducing risk. And it is. But there's such a thing as over-diversification, and it can actually hurt your returns. Remember the old 3-fund portfolio? It usually looked something like this. 1. US stocks, like VTI. 2. International stocks, like VXUS. 3. Bonds, like BND. The idea was to spread your risk across different asset classes and geographical regions. Sounds smart, right? Well, here's the kicker. Over the past 10 years, VXUS, international stocks, has only returned about 3.7% per year, and BND bonds, a measly 1.3% per year. Here's what Warren Buffett has to say about diversification. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Now, I'm not saying to put all your eggs in one basket. But consider this approach. 1. Focus on high-quality ETFs with strong track records. 2. Don't diversify just for the sake of diversification. Make sure each holding has a purpose in your portfolio. 3. Consider a more concentrated portfolio of ETFs you really believe in, rather than spreading yourself too thin. Mistake number 3. Constantly changing your portfolio. This is perhaps the biggest mistake of all. You learn something new about investing, and suddenly you're scrambling to rebalance your entire portfolio. Every single month. I get it. The investment world is always changing, and it's tempting to want to keep up. But constantly tweaking your portfolio can lead to higher transaction costs, potential tax implications, and missed opportunities for long-term growth. Here's how to avoid this common pitfall. 1. Develop a solid investment strategy based on your goals and risk tolerance. 2. Choose ETFs that align with this strategy. 3. Set a schedule for reviewing your portfolio, maybe once or twice a year. 4. Make changes only when necessary, not based on short-term market movements or the latest investment fad. 5. Remember, the best investors are often the most patient ones. Bonus tip: understanding ETF expense ratios. Before we wrap up, let's talk about an often overlooked aspect of ETF investing: expense ratios. These are the fees you pay for the privilege of investing in an ETF, and they can eat into your returns over time. For example, let's compare two popular ETFs. 1. VTI, Vanguard Total Stock Market ETF expense ratio of 0.03%. 2. IWV, iShares Russell 3000 ETF expense ratio of 0.2%. Now, 0.17% might not seem like a big difference, but over time, it adds up. On a $100,000 investment over 30 years, assuming a 7% annual return. With VTI, you'd pay about $3,000 in fees. With IWV, you'd pay about $20,000 in fees. That's a $17,000 difference. And remember, that's money that could have been compounding in your account. So, when choosing between similar ETFs, always consider the expense ratio. It's not the only factor, but it's an important one that can significantly impact your long-term returns. Bonus tip number 2, the power of dollar cost averaging with ETFs. Another strategy to optimize your ETF investments is dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of market conditions. For example, let's say you invest $500 monthly into VTI. Month 1, VTI is at $200 per share, you buy 2.5 shares. Month 2, VTI drops to $180 per share, you buy 2.77 shares. Month 3, VTI rises to $220 per share, you buy 2.27 shares. Over time, this approach can help smooth out your average purchase price and potentially boost your returns. Investing in ETFs can be a powerful way to build wealth over time, but like any investment strategy, it requires knowledge, patience, and discipline. By avoiding the common mistakes we've discussed today, chasing returns without understanding holdings, over-diversifying, and constantly tinkering with your portfolio, you're already ahead of the game. Remember, successful investing is not about finding the perfect portfolio or making constant changes. It's about creating a solid strategy aligned with your goals, sticking to it through market ups and downs, and making informed adjustments when necessary. So, whether you're just starting out with ETFs or looking to optimize your existing portfolio, keep these principles in mind. Focus on understanding what you own, keep an eye on those expense ratios, and consider dollar cost averaging. That's all for today, investment superstars. If you found this video helpful, you know the drill: like, subscribe, and hit that notification bell. And remember, in the world of investing, slow and steady often wins the race. Until next time, invest wisely and prosper.